Katelyn. I also go by KP. I'm the CISO for Robinhood Crypto. I've also spent time as head of security for digital assets at Bank of New York. I was in a deputy CISO role and head of digital asset custody at BlockFi. Also spent some time at Bakkt on the custody engineering team, and then was a early founding member at KPMG for their blockchain and crypto practice.
Impressive.
Thank you.
I am Jacques Boschung. I am since beginning of September the new CEO of Halborn. Before that, I spent 2 years CEO of Kudelski Security, which is a traditional managed detection and response provider. And before that, I was working in the US managed healthcare system for big data analytics in a company called Innovalon. And before that, I spent 14 years at Dell Technologies. In my last capacity, I was Senior Vice President for EMEA, for Alliance, System Integrator, telco provider, and so on. That's me. So that's us. Now, in case...
Also impressive.
Right? Which is very good. So, KP, it's becoming more and more clear every day that traditional finance institutions are feeling much more compelled than ever to adopt DLT. But there is this huge contrast between their approach and how fintech and DeFi do things. Robinhood is a financial services company best known for its commission-free trading platform, and you allow your user to trade a wide range of assets, including stocks, ETF, options, and cryptocurrencies. So you are, I would claim, a good hybrid, fintech, traditional. So from your experience working with both and for both, what do you think is holding banks back? And what are the key factors pushing them forward down that road of digital assets?
Yeah, I've been fortunate to work on both sides of this. So I've worked at several fintechs and then also banks. And I think the biggest difference is that fintechs are able to move very, very quickly. Crypto also moves very fast. So while crypto moves fast, you have fintechs who are able to kind of keep up with that speed and like release new products and features at a pretty high velocity. Banks have too many like regulatory and infrastructure challenges that slow them down. I don't necessarily think that is a bad thing, but there's a lot of demand for and from institutional clients. And I think there's a lack of clear framework, something like a NIST for crypto, and other frameworks, adopting crypto that banks already use. And I think that creates a bit of a blocker for them, because they are so heavily regulated. And I think having to explain all of these new products to regulators can be very challenging for them.
I agree. But it's an interesting tipping point where we are. I personally believe that we are in the middle of a new digital transformation for the global financial market infrastructure. It's happening right now in front of us. And to your point, banks have already gone through 2 major waves of digitization. The first one, between the 70s and the 19s, in the previous century, okay, where paper was displaced by digital equivalent. And that was the age of COBOL programming and mainframe. By the way, mainframe is still around today.
It is, yes.
Then in the 2000 or 2000 plus, it was the second digital transformation, e-banking, private cloud adoption. And it was not a real major adjustment. It was just digitization of existing processes. But this new tide, this new wave I am speaking about, is really deeply transformative for me, because the issuance of tokenized securities, bonds, equity, derivative, the ongoing challenge of putting things on-chain trading, speed of light settlement of transaction, cost reduction at scale, that's really setting new standards for financial services institutions. And I believe none of them can ignore that.
Yeah, absolutely. I think, some of the banks I've worked at have been working on tokenization of traditional assets for actually a very long time. Years at this point, whereas some of the fintechs I've worked at are able to, adapt quickly and be like, okay, we're just going to go ahead and do this. But I think the regulators and kind of powers that be are looking to the banks for how to do this. and then hopefully set up the proper like guidelines and guardrails. But yeah, I think digitizing, money and or digitizing traditional assets and putting them on chain, I think has been, I mean, we've been really talking about it since 2018, right? And I think we've been exploring it probably somewhere around that time frame. I think just now we are actually starting to see companies, whether a bank or fintech, go ahead and actually do it and release products or getting the infrastructure in place, talking to regulators about what that product would look like. Both in Europe and the US. So I totally agree with you. It's definitely here. And it's something that they're doing it already, but they're going to have to do it even more.
I agree. But it's interesting because you are mentioning the standards. I think you mentioned NIST.
Yeah.
We could have spoken about ISO 27001. We could have spoken about PCI DSS. We could speak about helpers like FFIEC, self-assessment tool, and so on and so forth. And that's really a missing component for the blockchain or the DLT landscape, because even the cryptocurrency security standard CCSS, it's a bit limited in scope, don't you think?
I do. I like CCSS, but yeah, I think it's limited towards like safekeeping of digital assets more so. I think it's very focused on like key management. It has a couple other areas, but I think it's actually quite focused on custody, which I think is a big part of all of this, right? Like even whether you are custodying assets, Bitcoin, Ethereum for trading or other purposes, or tokenized assets, your custody platform still has to be able to be secure and look the same as it would for, they're not traditional assets, but just like custody and cryptocurrency. I also think there is a way to design and build both of these and either leverage the same platform, but in a like unique and secure way. But I think it's interesting because the custody platforms are actually certified they'll go for ISO or SOC or some of these other certifications. I don't know how much they look at CCSS, but it is a good framework. There are also other foreign like governing bodies like Bermuda Monetary Authority that have great frameworks around how to manage like keys for custody and do security for crypto assets. So I think it's very interesting. The fact that none of these standards, I think we've talked about 6 or 7, actually all say the same thing or have a consensus yet after all of this time, I think is quite interesting, right? Because SOC and ISO are talking more about like security and common control framework and principles. CCSS and some other standards are very focused on like key management and your custody platform. But nothing's kind of putting it all together, right? And I actually think what we're missing is like secure design principles for custody platforms. Like that's not something that has been published or actually like socialized more so with the public, because there are a number of principles that you should actually be building against. And I think if you build against those principles, you will have like pretty good security from the start. So I think trying to use things that aren't applicable and then weave in other things that kind of talk about what you need leaves a lot of gaps.
So custody is a big topic. I mean, you come from the largest custodian in the world because you used to work at BNY Mellon. I believe they have under custody more than $46 trillion of assets.
Right.
How was it there? How was the custodian approach, I would call that in this way, between classical centralized assets and DLT type of assets? Did you experience that?
Yeah, so I was there actually like not too long ago, probably it's been almost a year since I left, but was fortunate enough to be able to help design and build our custody platform for both crypto assets and tokenized assets. And the way that the bank has approached doing custody, I think is actually like something that other places should model after. Very hard to compromise funds and or people at each and every point of fund movement, right? So I think they've done a great job. I think the industry, like what they're doing is absolutely what the industry needs. Like you need a secure, trusted custodian for either tokenized assets or your crypto assets. Yeah, I mean, I totally think they've done a great job, and I've built custody several times at many other places. It's one of the hardest things to build. I think every time I've built it, I'm like, oh, this could still be better over here. We could still do this, or there's still more to do on this side. Like, it is truly one of the hardest things I think to build in the industry. But I think they've done a great job. Their approach on how they've done it. Yes, it's been a slower rollout, but the quality of what they built is very good.
Yeah, which is a good news because
Yeah.
there have been lately, as you know, some issue with external custodian, and this is one of the driving forces why banks are really trying to develop that by themselves. But that really puts them on this brink between fintech and traditional financial institution. And as we speak about this DLT adoption, there are many differences between our banks and fintechs approach that thing. So what would you say in terms of what are those biggest differences, and how would you try to reconcile, the very much centralized, standard-driven, IT-driven way of doing IT in banks with this agile, on-chain approach of fintech? What does that
Yeah,
tell
I
you?
think they're so different, right? In the approach. I think having worked for both, it's a big adjustment, right? Especially when you're working on the security of what the company is building. Banks are inherently going to be more risk averse. I think because to me, custody is security. So like if you are building on-chain infrastructure, you are building custody, your main focus of all of this needs to be security. It is actually a, contrary to popular belief, I think it is a security product. So I think the risk averse approach gives banks like a better end-to-end solution design. But I think it takes very long to roll something like this out. Inherently, it does take a long time to build. I always tell people, like, if you're trying to build something like this, it's 12 to 18 months if you do it right. You can always do it, in a shorter amount of time. But I think there needs to be like a bit more of a balance, right? Like fintechs need like the ability to have like a secure and trusted platform that can scale to hold a large number of assets. I think you see that a lot in fintechs and startups, right? It's like build fast, break things. This may work for this amount of assets. It may not scale in the future. It's an iterative approach. Banks are automatically going to build for the max amount of funds that they think they're going to have because they're very focused on risk management. I do think they could be more like they could adopt a more innovative mindset or a more agile mindset in some areas. Um, yeah, I mean, I think it's a trade-off, right? And it really
Yeah,
depends
it's a
on like
trade-off.
your
No,
risk
also
appetite.
one thing which is so different, and I think it's a mental barrier also for traditional bank. Those two notions of KYC and KYT are fundamentally new in this world, okay, of fintech, of DeFi. And those are really key pillars of how banks are running their business.
Yeah.
So, and the other thing also, if you think about the DeFi, they are using open blockchain. They are using Ethereum, okay? Whereas the banks are making all their trials, so most of them, on permission blockchain of their own. And
Yeah.
that's also a significant difference. It's interesting for a company like Halborn because we have a very broad experience in assessing the architecture and the security, secure by design, you said it before, of those private layer one, from runtime to consensus mechanism through transaction validation and block generation is one of our strong suit. But it's always a very interesting conversation with those guys when they have to move down that road. Surely something you have seen in your career.
Yeah, I'd love to know like kind of what you think about this too, because you do get to see both sides. Like you work with a lot of institutions, whether it's a bank or a fintech. I've worked with you guys at several places that I've been at. I know you guys also work with a lot of like crypto native and on-chain projects where it's probably like, 5 or 6 people who have designed and built a protocol that want your help.
Yeah.
Um, I think this is kind of what I think. crypto inherently and like the decentralized nature of blockchain is not actually conducive to financial institutions. I think like it was built outside of a financial institution with
Yeah,
the
that was the
intention.
purpose. That was the
It
initial.
was the purpose, right? So now you have, it's almost, I don't even know what the right word is, but you have banks and fintechs trying to adopt something that was not designed or made for them and trying to make it work and as the only way you could offer it to the masses. So I mean, I'm interested to see what you think. Like you're trying to take something that was not designed in a centralized manner and make it centralized. So you're doing this balance of centralization and
Yeah,
decentralization.
absolutely. And
And to
that's,
your
yeah, so you are spot on. So we have more than 500 customers. We
yeah,
have more than 2,000 engagement with those customers. A lot of Web3, a lot of DeFi, a lot of smart contract audit, as you may imagine, but much more than that. Layer one assessment, key ceremonies, custody is a big thing that we do as well. But I will tell you one anecdote, which is for me a fantastic summary of what we have been experiencing. Very early on, the team at Halborn developed a new solution that we call Seraf, okay? Which is, what is it? It is a policy enforcement, it's a smart contract that sits on top on EVM, so Ethereum, okay? But it's a policy enforcement engine. It has segregation of duties. It can approve transaction and it can simulate transaction, and it's also an intrusion prevention tool, okay? And that solution exists for the last 2 years. We have been optimizing it, enhancing it continuously. But so far, it was not very popular with DeFi. Why? Because it has this notion of centralized control. Whereas now we are presenting that solution to banks, and guess what? They love it, okay?
of course.
Because policy enforcement, that really rings a bell in a world of data compliance and compliance in general. So it's very interesting. It's very much possible that the solution gets extremely popular in enterprise type of accounts, so financial services, and would never have a good footprint in the Web3 world. So I love that story. And when I discovered, coming from a world of centralized IT, which is my world essentially, I thought immediately, oh, Seraf, fantastic. Why don't we scale that up? And now we can do that exactly because of this new digital transformation we were speaking about.
Yeah, absolutely. I think, and those tools are great for these institutions because unlike a DeFi project, institutions have regulators asking a ton of questions about how you would do policy enforcement. How are you maintaining segregation of duties? Also, at times too, your financial institutions depends on the project, right? Like there are DeFi projects that hold tons of money. But institutions are probably holding more and or the most. I also think that institutions, if an institution is compromised, like a major custodian or a major player, the adverse effects that has on the industry are far more than like the reach of like a DeFi project potentially having an issue. While those can also be catastrophic at this stage, given where we are with regulators, given the landscape and the environment that we're in today, and the way that it has, we're trying to make it more mainstream and more accessible. I have thoughts on DeFi and how it's not actually as accessible as we think that it is. So if institutions are the way, I think something going wrong there is much more
Oh
catastrophic.
yeah,
One,
that
for
would
that
be an
institution,
earthquake for the entire
literally.
industry. Yeah, absolutely.
Yeah. So
Yeah.
things like this are actually much more the stuff that you guys are doing in the policy enforcement and like transaction simulation. Like these are all things I've worked on at every single place because we don't have any room to make a mistake
No,
or
no.
potentially lose a large amount of funds. I think that is also a big difference with some of these DeFi projects versus institutions. Not only is it potentially a regulatory issue, the reputational damage, and then the downstream effects it has on the industry with only having a few major players in the space, especially at this time. It's not like it was in 2020 and 2021 where you had tons of crypto companies that popping up with different product offerings. Like we're not in that space anymore. There's only a few people left. If anything goes wrong with one of them, like we're just continuing in a downward spiral.
Yeah, I agree. But you know what? If you think about the total value lock on DeFi projects, so I saw numbers end of September, $80 billion. Still, so it's not, I mean, it's not Mickey Mouse money, okay?
Right.
And that liquidity is fragmented across different blockchains, layer
Yes.
one, different projects within the same blockchain, okay? And that means numerous smart contracts. And that's really a key difference between TradFi and DeFi. This very high level of fragmentation, which drives a totally different mentality to the risk factor that you were speaking about. So yeah, it's a fascinating convergence. I speak about convergence, by the way, when I speak about what's happening between the DeFi and TradFi and how they are getting to the same point of more compliance for DeFi and more traceability and more policy enforcement, back to the point of Seraf or solution of Halborn. And on the other end, more, I would say, agility and more on-chain mentality for the large banks. So again, because of your roles in the past, you have been at the crossroad of all that.
This brings up probably an interesting topic. So I've spent a lot of time obviously building custody, securing custody, building disaster recovery for custody systems. I've done self, I've done institutional. I think it's very interesting because you'll have banks are traditionally offering like institutional custody for institutional investors. Somebody like a BNY doesn't have like a retail business. But fintechs or someone like a Coinbase or even Robinhood, we have self-custody wallets available for our users. Do you think, like between the self-custody model and then the institutional custody model, do you think there's potential on the topic of convergence? Do you think there's potential for these two different types of models to converge really at like any point in their approach and how custody is handled?
I believe so, because if you think about it, managing and safeguarding digital assets, is it by yourself or with custodians, that does introduce unique risk, the need for secure private key storage, protection against hacking and regulatory compliance, which is moving up. Okay, so many banks are not equipped yet to handle that. So for me, as far as this new way is concerned, custody of the equity token is really more critical than ever. And what we have seen, because we have this massive Web3 experience, and we have all the tools and skills to contribute to what I call a secure by design custody approach for the banks. Well, my hope, to your point, is that the traditional financial institution, they will really adopt secure by design. And they will really understand that, unlike in traditional IT, I come from cybersecurity in traditional IT, okay?
Yeah.
There, you know what? You can have a breach, you can have a data leak, you can have multiple hours or days sometimes between the first indice of compromise and an actual ransomware or an actual data leak. Whereas on-chain, if something is happening, money vanish immediately because it's like a bank robbery at the end of the day, okay? So secure by design, architectural thinking upfront on how to do things, it's really where I would like the custodian, they can be service provider, and they can be the banks themselves to go. And that's where Halborn, we can really help. And we will see also, and that would be my long answer to your short question, we will see also a convergence of the procedure, of the IT practices. We will see best practice sharing. All those things do not really exist yet, whereas they exist at scale, as you know very much, between financial institutions and their IT departments. So we live in interesting times.
I think we do live in interesting times. I also think it's interesting that, kind of going back to the earlier point we were talking about, crypto started out as self-custody. It was never intended as something for institutions to do.
Yes.
Some of the challenges I have seen building on the institutional, on the retail side and on the institutional side, is that you are taking products that were designed for an individual user to solely be responsible for as a single person, and trying to adapt that into an institution where you have many people involved, whether you have developers or you have operations people, you have security people, like trying to make something that was only intended for one person to access like bifurcated out and distributed across a lot of people is that's why it's so hard, is because it was
It's a
never
real
intended to
scale
be a
up.
centralized
It's a real
product.
scale up, huh? And in that case,
Yeah.
it's incredible.
Yeah.
It's very hard. And on top of that, you have all the compliance, because when it was for a singular, an individual user, compliance was like swearing, okay? And now it's pervasive.
Well, yeah, and I think, crypto was originally intended to be anonymous. Like the whole point of that was to be
Yes.
able to transact without somebody knowing who you were, where you are, how much money you have. And I think
Whereas the transaction itself was fully transparent because it
yes,
was on the public ledger. So that's a total swing. And by the way, in the original white paper of Satoshi, he makes that very clear, the difference in the transaction and the difference in privacy and in enforcement of transparency. So we are still here. We are still debating. We are still struggling with those things.
yeah, and I think at an institutional scale, when you have retail clients, like this topic comes up all the time when we are designing something. Like there are certain things we have to do around KYT and KYC, but like where do we draw the line, right? Because you think of crypto users, like they're using crypto for a reason. So at what point, right, are you,
Sometimes bad reasons, sometimes.
yes, but at what point are you doing enough of what you need to do, but also not like invading their privacy
Yeah.
or like kind of crossing those boundaries that have really been set by like the original standards and white papers. So it's really hard.
Very hard, and that would be a fantastic conclusion for this exchange, I believe. So thank you very much. I think it was really great to have this conversation, and hopefully we can do more of the same.